Most people do not fail at investing because they are stupid. They fail because they install the wrong financial operating system, then spend 20 years pressing buttons harder and wondering why nothing works. I have watched people buy stocks while carrying credit card debt that charges more than many businesses earn on their best day. I have watched them chase dividend yields while their checking account is one bad transmission, one emergency room visit, one layoff away from panic. I have watched them argue about the next great company while ignoring the fact that their own household balance sheet is already running malware. You do not need another hot tip when your foundation is corrupted. You need the right sequence. That is what most people refuse to respect. They want the feeling of investing without the discipline that makes investing work. They want to talk about upside before they have neutralized downside. They want a portfolio before they have stability. They want ownership returns while still living like a hostage to the next bill. I do not think wealth is built by excitement. I think it is built by installing a system that stops your money from leaking, stops your judgment from cracking under pressure, and gives compounding a clean runway. If you get the sequence wrong, the numbers punish you. If you get the sequence right, ordinary decisions start producing extraordinary outcomes. That is why I would not begin with stocks. I would not begin with crypto. I would not begin with options, angel investing, real estate speculation, or whatever fashionable object is making people feel clever this month. I would begin by asking a harder question: is your financial operating system stable enough to survive reality? Most people hate that question because it feels boring. They would rather discuss returns than resilience. But the stock market does not care whether you are entertained. Life does not reward you for being interested. Life rewards you for being prepared. The first job of money is not performance. The first job of money is not status. The first job of money is not even growth. The first job of money is to keep you from making desperate decisions. That is where almost everybody starts too late. They start with investing because investing sounds like progress. But if one bad week can force you to sell assets, borrow at predatory rates, or break the long-term plan you swore you would follow, you are not investing from strength. You are investing from instability. And instability is expensive. I want you to picture a simple machine. It has an engine, wiring, cooling, fuel lines, and control software. Now imagine a man polishing the paint while the radiator leaks, the wiring sparks, and the engine block is cracked. That is how most people handle money. They decorate the surface while the system underneath is sabotaging them. The first repair is cash reserve. I am not talking about a fantasy number that makes you feel sophisticated. I am talking about a real emergency buffer that creates decision. Making oxygen, $1,000 matters because it interrupts the immediate panic cycle. 1 month of living expenses matters because it begins to separate inconvenience from catastrophe. 3 months matters because it changes your psychology. It changes how you negotiate, how you sleep, how you respond to disruption, and how much nonsense you are forced to tolerate. People misunderstand emergency cash because they treat it like a low-return asset. They ask what it earns. That is the wrong question. The real return of an emergency fund is that it prevents stupidity under pressure. When your car fails, your child gets sick, your roof leaks, your job disappears, or your hours are cut. Cash keeps a temporary problem from becoming a structural wound. Without it, every surprise arrives with an invisible tax. The tax is panic. The tax is forced selling. The tax is high interest borrowing. The tax is breaking the compounding cycle before it has a chance to work. The people who dismiss this step usually imagine emergencies as rare events. That is another error in the operating system. Emergencies are not rare over a full adult life. They are guaranteed. What changes is not whether trouble comes. What changes is whether trouble finds you liquid or fragile. I do not want you forced to liquidate investments in a down market because your transmission died. I do not want you swiping a credit card at 22% to solve a problem that should have been solved by liquidity. I do not want your portfolio turned into a pawn shop because you confused invested money with available money. Cash reserve is not glamorous. Armor never is. But armor changes behavior. Once you have it, you stop reacting to every problem like prey. That is the first repair. The second repair is harsher. And people resist it because it feels like retreat. You must kill high-interest debt, not manage it, not rationalize it, not carry it while pretending your index fund will somehow outrun it. Kill it. If you are paying 18%, 20%, 22% on revolving debt, you are not investing. You are running uphill in wet concrete. Every dollar you send to the market while that debt compounds against you is a dollar trying to grow in one account while another account is on fire. I have spent my life thinking about capital allocation. That is all this is. Where does the next dollar produce the highest intelligent return with the lowest avoidable risk? People act as if paying down debt is less sophisticated than buying assets. That is vanity. A guaranteed return created by eliminating a guaranteed loss is one of the cleanest moves you can make. If a credit card is charging you 22%, paying it down is equivalent to earning a strong, tax-free, riskless return that most investors will never reliably match in public markets. The market can give you a good year. The market can give you a terrible year. The debt company gives you certainty. It will take its pound of flesh every month until you stop it. That is why I do not care how excited you are about the next stock idea. If you are still carrying expensive debt, your financial operating system is still infected, you are trying to install wealth on top of a background process that keeps draining memory power and stability. Now, there is one exception so important that many people misunderstand my position when they hear me talk this way. Before you finish killing every piece of high-interest debt, I still want you to collect the full employer match if your workplace offers one. This is where sequence matters more than slogans. If your employer matches part of your retirement contribution, that is not a normal investment return. That is immediate amplified capital. It is one of the few places in life where someone tells you that if you put down $1, they will add more simply because you showed up correctly. Refusing that is like walking past free ownership because you wanted to feel pure about your debt payoff order. I would contribute enough to capture the full match and not $1 more at that stage. That distinction matters. The match belongs in the system early because the return is too obvious to ignore. But after you secure that match, your extra cash should go straight back to strangling the expensive debt until it is gone. Not to stock picking, not to speculation. Not to fantasies of being a savvy investor while Visa quietly feeds on your future. This is how disciplined people think. They do not ask what feels most exciting. They ask what move improves the system fastest. First cash reserve, then debt elimination while still grabbing the full employer match. That alone would put millions of people on a radically different path. But most people still get seduced here. They taste the first sensation of investing and immediately want to skip the tax architecture that actually lets wealth compound cleanly. This is the next place the operating system breaks after the emergency fund is real, after high interest debt is dead, after the match is captured. Most people assume the next step is to shove every additional dollar into the employer retirement plan and forget about it. Sometimes that is fine. Often it is lazy. If your employer plan is expensive, limited, and cluttered with mediocre fund choices, then it is not automatically the next best container for your money. I prefer control when control improves economics. That is why the next layer for many people is the IRA. A good IRA gives you choice. It gives you range. It gives you access to broad, low-cost funds without the fee drag and narrow menu that trap many workers inside mediocre plans. And fee drag is not a trivial issue. Small percentages look harmless on paper and become a massacre over decades. That is the kind of damage most people never see because it happens slowly. Slow damage is the most dangerous damage in finance because people call it normal. I have no admiration for paying high fees to look respectable. I would rather own simple, low-cost instruments and keep more of my own compounding. That is the hidden intelligence of the IRA step. It is not just another account. It is a control upgrade inside the operating system. It says you are no longer satisfied with default settings designed for convenience over efficiency. That same logic leads to the next question that confuses people more than it should. Traditional or Roth? People ask it as if there must be one universal answer. There is not. What matters is when you want to pay the tax and what you believe about your future earnings, your future tax bracket, and your long-term flexibility if you are in low-earning years. Paying tax now through Roth contributions can be intelligent because the rate may never be cheaper for you again. If you are in high-earning years, a traditional contribution may be the smarter move because the deduction now creates breathing room when your tax burden is heaviest. What I care about is not ideological purity. I care about intelligent optionality. Sometimes the right answer is one or the other. Sometimes the right answer is both. Tax diversification is a form of strategic freedom. If every future dollar you withdraw is taxed one way, then your retirement choices are narrower. If some future dollars are taxable and some are not, you have more levers to pull. I like levers. Levers are what separate someone who merely saves from someone who allocates. But the great neglected jewel in the system, the piece most ordinary people walk right past, is the health savings account. If you qualify for one, I regard it as one of the most interesting and underused wealth containers available to ordinary workers. Why? Because it solves three problems at once. You receive a tax benefit when the money goes in. The money can grow without annual tax friction while invested, and qualified medical spending can come out tax-free. That is rare air in a world where the tax code usually takes a bite on the way in, during the growth phase, or on the way out. An HSA can give you a cleaner lane than almost anything else if you use it correctly. Most people use it like a checking account with a medical label. That is not the highest use, the higher use. When your circumstances allow it, is to pay current medical costs out of pocket and let the HSA stay invested. Save the receipts, let the account grow. Preserve that tax advantage pool for later years when medical expenses become not a possibility but a probability. In retirement, healthcare is not some side issue. It is one of the great financial gravity fields waiting to pull on your assets. Building a reserve that can attack that problem with tax efficiency is not just smart. It is elegant. This is what I mean when I talk about a financial operating system. Every layer should reduce friction, increase resilience, and widen future freedom. Cash reserve does that. Debt elimination does that. Employer matching does that. A well-used IRA does that. An intelligently used HSA does that. Each step is not random advice. Each step is a repair to the machine. Now, once you have used the IRA and HSA intelligently, then I would return to the employer retirement plan and begin pushing harder beyond the match. At that point, the logic changes. Once the inferior options have been compared against the tax shelter and the shelter still wins, then additional 401k contributions become a larger engine for long-term compounding. I want you to notice something here. By the time you reach this stage, you are not behaving like a consumer who occasionally invests. You are behaving like an owner who builds systems. That distinction is bigger than people realize. Consumers think in monthly leftovers. Owners think in capital channels. Consumers ask what is left after life. Owners decide where money goes before life gets the chance to waste it. That is why following the proper sequence changes more than your net worth. It changes your identity. The wrong operating system turns you into a reaction machine. The right operating system turns you into a capital allocator. And that is where the psychology becomes powerful. Once your cash reserve exists, you are less afraid. Once your debt is gone, you stop bleeding. Once your employer match is captured, you stop refusing free leverage. Once your tax-advantaged accounts are working, you stop feeding the IRS more than necessary. Every one of those moves reduces cortisol and increases control. That is not a soft point, it is a compounding point. Stressed people make short-term decisions. Stable people can wait, and waiting, when paired with sound allocation, is one of the highest paid behaviors in the world. But I do not want to romanticize this. There is still another layer where many people get careless. They hear all this structure and think the final step, the taxable brokerage account, is where the real fun begins. That attitude is exactly why many people end up with portfolios they do not understand, tax friction they did not anticipate, and a collection of positions that behave more like entertainment than wealth. Taxable investing matters. It has a real place, but it comes after the more efficient containers for a reason. A taxable account is flexible. That flexibility is valuable. It can fund opportunities before traditional retirement age. It can act as bridge capital. It can support a down payment. It can hold assets you want to leave behind. It can widen your strategic range in ways retirement accounts cannot. But flexibility without discipline becomes financial graffiti. Every dividend in the wrong structure, every unnecessary trade, every realized gain created by restlessness, every impulse to act because the app on your phone makes you feel like a trader. All of that creates drag. You do not always feel drag while it is happening. That is what makes it seductive. Tax drag, fee drag, and behavior drag rarely arrive as a dramatic explosion. They arrive as thousands of silent cuts that shave the snowball before it has a chance to become heavy. That is why the taxable account belongs later in the system. Not because it is bad, because it is more exposed. When you enter it after building the proper foundation, you come in as a stronger operator. You are not using it because you are impatient. You are using it because you have already earned the right to use the most flexible tool in the box without turning it into a weapon against yourself. And let me say something bluntly here. Most people do not have an investment problem. They have an order problem. They invest while broke. They invest while panicked. They invest while indebted. They invest before securing the match. They invest in taxable accounts before using the tax shelters available to them. They buy complexity because complexity flatters the ego. Then they call the result bad luck. It is not bad luck. It is bad sequencing. A man who puts money into a brokerage account while revolving credit card debt is not building wealth. He is staging a performance for himself. A family that argues over stock picks while one emergency could wipe out their savings is not investing. They are role-playing prosperity. A worker who ignores the employer match but spends nights studying charts is not serious about money. He is serious about stimulation. I have no interest in stimulation. I am interested in outcomes. Outcomes come from respecting incentives, friction, mathematics, taxes, and human weakness. The right operating system is built precisely because human beings are weak under pressure. We are tempted by novelty. We overestimate our discipline. We underrate taxes. We discount risk until risk arrives. We call a stable foundation boring because stability does not trigger dopamine. The market is happy to exploit all of that. Credit card companies are happy to exploit all of that. The tax code is happy to exploit all of that. Employers, fund companies, advertisers, and trading platforms all make money from your confusion. That is why clarity is valuable when you know the sequence. You stop donating intelligence to systems designed to profit from disorder. You begin by creating a survival buffer. You then remove the expensive liabilities that punish every future move. You collect the match because free capital belongs to the discipline. You use the IRA for control and cost efficiency. You use the HSA, if available, as a stealth compounding engine. You then expand your employer retirement contributions, and only after those layers are functioning cleanly do you widen into taxable investing. That is not a list to memorize. That is a machine to install. And once installed, it changes the trajectory of a life in ways people underestimate because they keep looking for one big breakthrough. I have never built my understanding of wealth on magical breakthroughs. I have built it on rational accumulation, correct incentives, disciplined patience, and avoiding stupid losses that masquerade as ordinary behavior. You do not need 10 brilliant moves. You need fewer self-inflicted wounds. You do not need to impress people with sophisticated investments. You need to stop living in a way that makes compounding impossible. You do not need to look rich while your system is broken. You need a system that quietly makes you rich while nobody notices. That is another error ordinary people make. They confuse visible signals with actual progress. A loud portfolio is often a weak portfolio. A flashy financial life is often a fragile financial life. The people who look most active are often compensating for the fact that they never fix the operating system underneath. I would rather be dull and durable than exciting and exposed. That is how serious wealth is usually built. Now let us go deeper into the invisible benefit of proper sequence, because this is where the life change really happens. When your emergency fund is real, you can say no faster. When your high-interest debt is gone, your income begins to belong to you again. When your retirement accounts are funded properly, time becomes an ally instead of an executioner. When your taxable account is used from a position of strength, flexibility becomes an asset instead of an excuse. That is what people are really buying when they build wealth correctly. Not just numbers, refusal power. The ability to refuse a bad boss, a predatory lender, a stupid financial product, a forced sale, an unnecessary tax bill, a panic-driven move, a humiliating dependence on the next paycheck. Refusal power is one of the greatest luxuries money can create, and it is almost never built by people who skip the boring sequence. The sequence is not boring. The sequence is liberation disguised as discipline, but liberation only belongs to people willing to face an uncomfortable truth. If your money is still chaotic, it is not because the stock market is too complicated. It is because you are still negotiating with steps that should have become non-negotiable. You already know the first principles: cash before confidence theater, debt elimination before market heroics, match before speculation, tax shelters before taxable enthusiasm, system before speed. That is the whole game for most households. And yet most households refuse to play it because they want the emotional reward of feeling advanced before they have earned the structural reward of being stable. Do not do that. Do not mistake motion for progress. Do not mistake investing activity for wealth building. Do not mistake a brokerage balance for a functioning financial life. I have seen small incomes handled with discipline create more long-term freedom than large incomes handled with vanity. I have seen people earning modest salaries build calm, flexible, owner-like lives because they respected order. I have seen high earners remain trapped for years because they fed the wrong accounts, ignored the tax code, normalized debt, and acted as though compounding could save them from disorder. Compounding is powerful, but it is not a miracle worker. It does its best work in a clean system. If you install it inside confusion, it spends too much energy fighting leaks. This is why I want the sequence burned into your mind, not as a checklist, but as a test of seriousness. If you are still carrying expensive debt, you are not ready for aggressive investing. Admit it. If you are ignoring the match, you are still refusing obvious leverage. Admit it. If you are using taxable accounts while your tax-advantaged options sit half empty, you are paying an unnecessary freedom tax. Admit it. If one unexpected bill could knock you off the path, your operating system is still unstable. Admit it. That honesty is where wealth actually begins. Not in prediction. Not in brilliance, not in excitement, in honesty. Because once you tell the truth about the system, you can finally repair it. And once repaired, ordinary behavior becomes surprisingly powerful. A worker who consistently captures the match, eliminates toxic debt, funds the right accounts, and invests patiently is no longer a victim of the modern financial machine. He begins to use that machine for himself. A household that structures money with discipline may still look ordinary from the outside, but internally it is building one of the rarest things in modern life: compounding without chaos. That is the goal. Not to look financially sophisticated, to become financially hard to kill. There is a point where the system begins to hum. Bills are paid without drama. Emergencies do not trigger collapse. Retirement accounts grow without constant tinkering. Taxes are managed instead of ignored. Investment decisions become quieter. Life becomes less performative. The machine stops consuming you and starts serving you. That is when money finally changes character. It stops being a source of constant microstress and starts becoming stored judgment, stored options, stored time, stored dignity. I want that for you more than I want you owning the next fashionable stock, because fashionable stocks will come and go. A strong operating system can carry you through all of them. So here is the final test. If I took away the market headlines, the stock app, the hot tips, the social media gurus, the podcasts, the predictions, and every seductive conversation about easy money, would your financial life still be getting stronger? Would the machine still be improving in silence? Would cash still be building where it needs to build? Would debt still be dying? Would the match still be captured? Would the tax shelter still be filling? Would your flexibility still be increasing? If the answer is yes, then you are doing real wealth work. If the answer is no, then you are still depending on stimulation to feel like you are making progress. That door is in front of you now. On one side is the old operating system. Panic, debt, leakage, tax friction, performative investing, and a life that looks active while remaining fragile. On the other side is a cleaner system, buffer, discipline, efficiency, patience, ownership, and a life that becomes harder to bully with each passing year. You do not need permission to choose. You need the courage to stop pretending sequence. Does not matter. The market will not rescue a broken system. The next stock will not rescue a broken system. A higher salary alone will not rescue a broken system. Only disciplined installation will do that. So decide who you are, the person feeding coins into a machine he does not understand, or the person who finally shuts the machine open, repairs the code, and forces every future dollar to serve a rational life. That is the choice. Make it before another year of your energy disappears into a system that was never built to protect you.